Good morning. Today we are going to discuss few more basic terms of accounting. The terms are mentioned here. Let's start. The first term is revenue. Revenue is the amount which is added to the business by selling its products and providing services to customers. Interest received, commission received, royalties will also be treated as revenue. They are the amount which the business receive. Okay. So again, revenue are the amount of the businesses earned by selling its products or by providing services to customers. Like Reliance Industries is selling petrochemical products. So whatever amount it is receiving is a revenue for Reliance Industries. In the same manner, Reliance Industries may be receiving interest on its fixed deposits or other investments. Commission it may be receiving. Okay, it may be receiving some royalties. So all will be treated as revenue. Expense. Expenses refers to the amount which are spent by the business to generate revenue. Okay, cost incurred by a business in the process of earning revenue are known as expenses. Okay, amount spent. Generally, expenses are measured by the cost of assets consumed, like raw materials are consumed or services are used during the accounting period. See, some of the examples are like rent, wages, salary, light and water, telephone expenses. So these all are expenses and they are incurred to generate revenue. Next term is income. Now, income is a broader term than profit. Income is the profit earned during the accounting period. Okay. The formula is income is equal to revenue minus expense. Just now we had discussed the meaning of revenue and expense. So the difference between these two is income. Okay, income is a broader term than profit and it includes amount received or the profit earned from activities other than operating activities. Now, operating activities are those main revenue generating activities of business, okay, which is done on a more regular basis. Like Airtel is providing mobile services. It has some extra amount it invested in some shares or it has deposited as in the bank as fixed deposit. So interest received, dividend received will be non-operating incomes. Okay, so in profit it will not be included, but in income it will be included. Okay, in profit the profit from the main operating activities is included. Okay, gain, there will be a term gain. Okay, so profit means income earned by the business from its operating activities. Income includes income from main operating activities as well as activities other than operating activities, but in profit income earned from the operating activities is only included. Now gain, it is the profit that arises from transactions which are not operating activities, which are incidental, happens once in a while, like machinery is sold and gain is there. The business will not be selling machinery which it is using for production process on a regular basis, so the profit earned will be considered as gain. So in income, gain and profit both are included. Okay, loss, it is the excess of expense of a period over its revenue. If expenses are more, then the firm will suffer loss. Sometimes no benefit is received, like amount is spent and no services or no goods or items are received, so it will be also treated as loss. If the goods are destroyed by fire, then also it will be considered as loss. It decreases the capital, profit increases the capital, losses decrease the capital. It also refers to the money or cost incurred without receiving any benefit in return, like goods lost by fire or theft. Okay, will be treated as loss. Voucher, okay, how many of you have purchased things? You might have received a bill, no? So it's a document which can be treated treated as evidence of the transaction. In school you deposit fee, you receive receipts, so it is an evidence of the fees paid. So the documentary evidence of a transaction is known as voucher. Okay, the documentary evidence in support of a transaction is known as voucher. Like cash memo is there when cash transaction is there, and when we buy goods on credit we get invoice. Okay, invoice we get. Bad debts. Okay, we had discussed debtors earlier, no? Now some debtors may not be in a position to pay the business. Okay, in that case it will be a loss to the business, and the debtors who are not able to pay will be treated as bad debts. Okay, bad debts is the amount owed by business which is irrecoverable, which may not be received by the business. It's a loss. Depreciation, like we are using car, as the time is passing on, we are using the car, the value of the car decreases. The decrease in the value of car is known as depreciation. The fall in the value of asset due to use and passage of time or efflux of time is known as depreciation. Fall in the value of asset because of usage or efflux of time is depreciation. Solvent. Now solvent is a person who is able to repay his debts. Okay, position to pay its debts. Okay, and insolvent is a person who is not able to repay his debts, not in a position to repay the debts.